if everyone doesn't come in, then we're going to go back to the old donuts, the hard donuts of 25 years ago. You're all too well fed, I think. I think
Shall I kick off?
James, yes, why don't we?
Hello, everybody. My name's James Thomson. I'm the Chanticleer columnist at the Australian Financial Review. Thanks to Caroline and the team for inviting me today. Got a great panel of fund managers and Geoff Wilson.
Very good.
Sorry, Geoff. I always call you and you say, oh, I don't pick stocks anymore.
Exactly.
So,
but I have to have two for today.
Yeah, two for today, and we'll get to those towards the end. But I reckon, Jun Bei Liu and Jacob, we should start with the orange elephant in the room. We are on the eve of Liberation Day in America. I think we're 18 hours away from being liberated, or in the Rose Garden at the White House. Nobody has any idea what's going to go on. Jacob, you're a global fund manager at Antipodes. Can you give us a sense of what's going to happen, please?
Well, I think in some ways, a lot of the damage to confidence has already happened. So, if you take consumer confidence in the US, it's really at recessionary levels. Corporate confidence is also at recessionary levels. Now, that isn't yet showing up in what they call the hard data. We think it's, and look, it's for good reason. I mean, just the tariffs that have been announced on Canada, Mexico, and on all auto imports to the US represent a lifting of the tariff, the general tariff, the average tariff, to about 10%. Now that adds about 1% to inflation, and it's taken, most economists would say that's probably shaved about 50 basis points off GDP growth. So you've got the classic sort of a stagflation scenario emerging in the US. And that's before we've had these, generalized tariff announcements. Now, if they come in at 20%, then that inflation rate will be 2% higher, and the growth rate will be, shaved again. But what really could happen here is just a freeze on spending expectations and real nervousness amongst consumers, and that can become a self-fulfilling recession. So, we're pretty cautiously positioned in regards to our exposure to the US, more cyclical, less defensive exposures, sort of globally. We've been pretty cautious.
Jun Bei, are you like me, you sort of wake up in the middle of the night, reach for your phone and sort of look at it through one eye, hoping that there's no news alerts? It is pretty, it's one of the, there's a few times when fund managers sort of have to be checking the markets every morning, GFC, pandemic, but we're sort of back into one now, aren't we?
Yeah, sort of. Look, I actually do it every night. Just naturally, ever since I had kids, I wake up 2 o'clock in the morning. So I instead of looking for news alert, I look at Bloomberg, which is worse.
Yeah.
You're kind of looking at what the market has done. So yeah, look, it is volatile time, but share market, we experience that kind of volatility every couple of years, right? Every couple of years, there's a bit of, they call it the healthy pullback. Whether it's because it's got too expensive or, and everything else, but eventually we'll recover from it, right? So, but right now the volatility is interesting. We knew there will be some sort of tariff and Trump sort of volatility, which I didn't expect. He will publicly negotiate the trade position and tariff, just in open, and that has sort of caused a bit of indigestion for the share market and the uncertainty. So how do we price? We don't know what it looks like. Yeah. Ultimately, at the moment, all the share market need is just knowing what it is. Even if it's a bit higher, we talk about the impact on GDP and others, it's not massive. So there will be impact. And, if you draw a straight line, clearly economists will scare you saying, 50% chance or 60% chance, the US heading for a recession. No. Economy doesn't work in straight lines. Things work differently. Then the Fed will come in and cut interest rate. Then economists say, actually, it's not 50%, it's 20%. So, these probability by economists, they draw straight lines. So just, be a bit cautious about that. But overall impact so far is not that big. But it's what he might do is scary. You know, we don't know. He might say 100%, you know, and then he's doing that at the moment just to essentially negotiate publicly with different, you know, different country and counterparty. He wants to get better deal for American company, and he wants to protect some of the American industries and bring the jobs back. So that's his purpose. So we are in it for a little bit longer, but so this is just the sort of you know, opportunity that you see, because once you have stabilization, knowing what it is, market will recover very quickly.
Geoff, you've been through a number of different periods on markets.
I know, I've lost my hair
From,
because of the stress.
Exactly. 87, dot-com crash, GFC. Does this period remind you of something else, or is it a bit unique?
Well, I mean, the tough thing is, what does Ray Dalio say? History doesn't repeat itself, it rhymes. Or
Yeah.
A lot of people say that. I'm not sure what the rhyme is. One of the things, you know, when you ask the question and what's happening over there, and as I'm up on the panel with you, I'm thinking we should have paid a lot more attention when we were at that dinner at Alex Waitslitz's in Melbourne, and Scott Besson, you know, the Secretary of the Treasury, was sitting
there,
with us. We should have got a picture.
Yes.
And then said, and I think what's happening there is, you know, there's all this sort of negative, the uncertainty. Effectively, there's the detox, and let's hope it's only a 90-day detox, and then, you know, because the bond market looks as though it's, you know, it's not as fragile as the equity market, and it's probably good for some heat to come out of the equity market. And I suppose I tend to look at, you know, what's happening in the bond market as well. Back in, you know, whether it's in 87, you know, of course, bonds were backing up, you know, significantly. You know, obviously one of the risks of the market this time is passive money. You know, back in 87 we had, you know, portfolio insurance, et cetera, et cetera. But to me, I'm more the theory, if you want to, you know, what's happening over the next 12 months is you know, we're getting the worst stuff now.
Yes.
And the next, you know, 2 or 3 months, the volatility is going to be tough. You know, few of the excesses are coming out. And then I'm more sort of muddled through, and if you're taking a 12-month view, you're probably better off buying over this period, rather than, you know, sort of, you know, rather than it's going to be an Asian crisis or a long-term cattle management, you know, crisis, or a you know, 87 crash. That's my thought process.
Jacob, are you as sanguine as Geoff?
Look, I think you know, investing outside of the US has never looked better, in the sense that the relative certainty of markets like Europe, even China, you know, China's relative certainty versus uncertainty in the US, even in Australia, arguably. So,
well, depending on, we come to that later, depending on who wins.
Yeah.
and you know, certainty is about, you know, greater certainty is about lower discount rates. You know, a lot of investors just focus on growth and forget about the discount rate. And look, when we went through that cycle of uncertainty in China, you know, the PE multiple on the market went from, let's call it 15 times to 9 times, and has only just started to, you know, re-rate in a positive sense. So we think equities outside of the US will benefit from what Trump is doing. I mean, in many ways, he is making the rest of the world great again. And passive investors are significantly, you know, if you're in a global equity ETF, you've basically got 70% exposure to the US. So I'd be saying really focus on the 30%. It's cheap, and it's becoming more certain.
Jacob, just to finish that thought, I mean, your point about 70% of global ETFs are in the US, I mean, that's come down slightly. It was about 75% coming into 2025. I mean, you rewind, and you rewind 10 weeks. We're all talking about American exceptionalism. We're all talking about NVIDIA's going to go forever. We're all talking about why would you invest anywhere but America? The speed with which that narrative has changed, and to your point, the rest of the world looks great again, has that been confronting as a global investor?
Well, it depends how you've been positioned.
Yes.
Yeah, you've been positioned well. That's why you're in the Future Gen portfolio. Yeah. Exactly.
So I think it is. Yeah, look, if you think about the damage in people's portfolios in the last quarter, it wasn't actually tariff related. I mean, it was actually AI related. It's been the Magnificent Seven that have derated as the range of outcomes around AI has widened. So I actually think potentially, some of the damage from tariffs is yet to come. And then the question would be, can the market rotate into other areas? And look, we think AI is a classic example of you get the enablers, all the focus is on the companies that like NVIDIA that are enabling that.
Yep.
But then all of a sudden, as the price of AI adoption plummets, then you'll start to focus on the companies like the banks that will benefit from adopting AI in their businesses. So I think you can broaden out in that sense as well.
Jun Bei, give me your view on how what is happening in America is coming down to the ASX 200. There's some companies with US exposure, there's lots of companies with indirect exposure to global markets. Are you seeing any sort of spillover, even if it's in confidence and decision making?
Yeah, look, we are actually seeing spillover across share prices. Our whole index is being impacted, even though a lot of it is really not to do with us. What's interesting is that Australia is actually on a different path than the US. So US started cutting their interest rate mid last year, and then their consumer was going well, and then after rate cuts, so all these sectors like consumer sector and your tech sector doing well because of AI, but consumer sectors, your housing, everything else doing so well because of rate cut. Whereas Australia, we kind of just waiting. We're waiting for our rate cut, which happened, and we got potentially more to come through. Our inflation sort of easing in the right way, and so we just getting started. However, our sectors have yet to have the chance to actually go up, and this is when US suddenly everyone worry about recession in the US. So and then because global capital market is so integrated now, when people sell US consumer, they sell Australia consumer. They don't care if you have a rate cut coming through. You don't have all of that. Just because it's consumer. So we are seeing a lot of that. So which in a way make Australian equity, I agree with Jacob, I think opportunity is actually outside US equity. In Australian market, it's massive. The cyclical sector beneficiary of the rate cut, our property sector doing quite well. Our consumer sector, picking up. And then with so many sectors being sold off, that is actually not much to do with them. One other interesting company, I'll name names, which is BlueScope. It's actually the beneficiary of this tariff and everything. And guess what? Share price went down because everyone's saying, oh my God, US going to recession. No one will buy cars. No one will buy, building houses. And, market does that. They assume everything goes to zero. And then suddenly BlueScope is a sell. Even though at the current steel spread, because of tariff, BlueScope actually has 20% earnings upgrade to come through, yet share price is down. So we're seeing so much opportunity in the Australian market that earnings is actually not so impacted by those global movements.
Geoff, you're extraordinarily well connected on Wall Street. Bill Ackman, who is a great Trump supporter, is one of your dear friends.
I spent 20 minutes with him a year ago.
Close enough.
and he persuaded me to go on Twitter.
Exactly. So you
and because he said, I don't know if I've told you this story, have I?
Oh, well, tell it now, please.
Yeah,
Can't leave us hanging.
Because, hey, I'm not a social media person. I might be like a lot of the older people in the room. I think I joined Facebook when I was in a group like 20 or 30 years ago, whenever it was. So I've got 30 friends on Facebook. I never progressed from that. And then, sitting down with Ackman, March last year. There was talk he was going to do a listed investment company, raise $10 billion. That was the talk. He'd lodged the prospectus, but you didn't know the size. So I was there, naive. I had I had a year of shareholder engagement strategies. I thought I could help him.
Show him something.
Yeah, what he needs to do, because his other LIC was trading at a 30% discount. And anyway, we sit down there, and I said, look, how are you going to raise the money? And he said, tweet. And he said, and I said, so you're going to raise 10 billion like that? And he said, no, I'm going to raise 25 billion.
We should point out it never happened.
Exactly, that's right. And unfortunately, then he sort of persuaded me to go on Twitter, and now I'm sort of in.
He left you high and dry. Well,
sorry, back on Wall Street.
back to the question.
And the only other thing, and James Gorman, that was my only other association.
Oh, well, there you go.
we went to prep together.
Well, that's
But he's left Wall Street.
So you're affiliated with two Wall Street powerhouses. Do you think Trump pulls back from the brink eventually and says, "Oh, you know, I was only kidding. It's all a negotiating tactic"? My sense is he's had a few chances to do that and he hasn't done it. What do you think?
Well, no, I think sanity. Well,
sanity.
Sanity doesn't prevail with him.
Right.
But I think I've got enormous respect for Besson, and I think sanity prevails there. And I mean the tough thing is taking a step back. We all knew the tariffs were coming. But we all effectively we're getting all the bad stuff, and the good stuff's coming in terms of the tax cuts, the deregulation, etc. I'm still of that mindset that and the fact that the bonds. I know there's risk of recession's increased, but the bonds aren't telling us.
Yeah.
If the bonds, if things change in the bond market, then it would worry me a bit more. But to me, I am on that sort of. This is your detox, and then you're going to start eating some good food. And things will feel good again.
Yes, broccoli before dessert.
He's got midterm to worry about. He needs the share market to start rallying into midterm.
Absolutely. He's going to have some very unhappy Republican colleagues. Jacob, just on Europe and China again, I just want to bring out a bit of that point. Europe has gone from looking cheap without much tailwind to looking cheap with this huge tailwind of fiscal stimulus, particularly around rearmament. Is that something that you're looking to get more involved with?
Yeah, look, we've been roughly double overweight Europe, not because we think European macro is amazing, you'd have to be delusional, but because you can get amazing multinational companies, like global companies that just so happen to be listed there, companies like Siemens, Sanofi, Airbus, very dominant in their category. And they were trading at a roughly 40% discount to comparable companies in the US. And that just seemed to us to be unsustainably cheap. And now, on top of that, as often happens in markets, the macro does come your way when stocks are cheap. And that is this loosening of the debt brake in Germany. So what Germany has done is very fundamentally, very, very, a real break with history. So they're excluding all defense spending from the calculation of the fiscal deficit. And that will add about 2% to GDP in additional spending and additional fiscal stimulus. On top of that, they've also allocating roughly 500 billion to decarbonisation and infrastructure spend. And you can think about that, like for a company like Siemens, it's almost a fiscal package designed for that company. And that's what you're picking up now in Europe, and now it will go beyond Germany. It will be at the EU level. Lots of different spending is being excluded from the calculation of your deficit. So to put it in context, from Trump 1.0, 2016, when he was first elected, through to under Trump, Biden, and now Trump, the US has stimulated roughly equivalent to 50% of GDP in fiscal spending deficits. Europe has done about half of that. So what you're seeing in Europe is really just a catch up to what the US has done. Now, what people are not doing is they're not normalizing US equities for above trend earnings. They're putting high earnings on a high multiple, whereas in Europe, you're buying low earnings on a low multiple. So yeah, it's pretty exciting.
Yeah.
China, well, similar story, but maybe slightly different in the sense that the Chinese won't want animal spirits to come back too aggressively. You'll see much more gentle nudging of the economy. They've resized the property sector, But I think what has really changed in China, when President Xi sits down with Jack Ma from Alibaba, when DeepSeek gets more mentions in the, in the Communist Party, and by the way, that is a AI large language model that was developed by a hedge fund. When the Communist Party is celebrating these things, the private sector is back in favour.
Yep. Jun Bei, there's an argument that we're all watching Trump, of course, but what happens in China over the next 9 months, the balance of the year, could actually be more important for ASX 200 stocks, right?
Absolutely.
Are you watching that?
Yeah, absolutely. Look, I actually think a lot more important. As we said before, what Trump does is creating volatility in the share price for the short term, right? So eventually when he sort himself out, when he decided what the number will be, the share market go back to normal. When it's normal, investors then will look at what the earning actually impact has been. So if company being sold off too much, when the earning hasn't been impacted, the share price will rise, right? So this is your opportunity. And so for most of Australian companies, it's actually China. So we're watching it very closely. So, in terms of the commodities, they want to use more, iron ore is a little bit different, but they're still using it. Price is okay. They want to use more copper. They want to roll out the grid, and, they want to digitize their economy. So a lot of copper is required. And guess what? Copper companies are down, right? So because of what's happening in the US. So, look at some of these. We will see support for those sectors here in Australia once that volatility and uncertainty passes in terms of the US. China consumer exposure, they're doing really well. So hence why we're already seeing the share price responding like the A2 milk. For the Australian side, we actually think China is far more important and watch that closely. And good news is it's getting better, not getting worse.
Yeah. Just on ASX 200 earnings, we've just been through the February reporting season. We've had a month to digest it. There's some wild share price swings. It was quite incredible. But what did you make of the earnings themselves? I mean, it felt pretty middling, but to your earlier point, perhaps that's because we haven't seen the consumer turn up with the benefit of rate cuts.
Well, look, actually, share price is clearly not reflecting the earnings at the moment because of what's happening globally, and also because of we actually have a big hedge fund community here, and then creates a bit of a price dislocation. They call it short-term price moves. So don't worry about those. Earnings itself, corporate Australia is doing okay. Earnings miss a little bit. That's because the margin under a bit more pressure. Wage costs still a little bit high. Retailers, they need to entice shoppers through the door. They have to discount more. But look, demand front is doing well. People still spending, people still holidaying, things are doing okay. One of the things that kind of create a bit of uncertainty is that a lot of large companies sort of a bit cautious going into the next 6 months. That's because we've got election coming. So banks don't want to show their massive profits heading into election year. Then you get a bank tax. So, so very cautious. And the insurance company, they already made headline about insurance premium increases so much. And, so clearly they're going to say, not so much. So just a bit of level caution heading into the next 6 months. But fundamental, Australia is actually not doing too badly.
Yeah. What about the international earnings season, Jacob? Was it okay-ish?
Well, it's probably what was notable was it was the first sort of earnings season where, in a while, when the mega cap tech stocks didn't upgrade. Forward earnings estimates stayed flat. Like, they're growing, but they weren't upgraded. And the rest of the market, like the S&P, the other 493 companies, there was about a 1% downgrade on future earnings. So how would you describe that? A bit lukewarm?
Yeah.
I suspect, given the shift in uncertainty, some of those earnings are probably looking a little bit vulnerable because in the US, you're not, as Jun Bei pointed out, we're getting rate cuts. Here, we're getting rate cuts in Europe. We're not getting the same level of rate cuts in the US. So the higher for longer is eroding. The areas in the US economy where you would be expecting a rebound is in the consumer areas where you've been, big ticket items that are sensitive to interest rates. That's where consumers have pulled back. New housing, right? New housing, autos. And you're just not seeing a rebound in that area at the same time that the service economy, which has been operating above trend, is starting to weaken. So areas and services that are particularly weak, travel. All the travel stocks, the airlines, just reporting. Discretionary spending, very sensitive to, the Americans have run out of their excess savings that they had from COVID. a number of holidays, ski holidays. Even in the wealthier cohort, they're pulling back on that spending, and geopolitical uncertainty doesn't help that. And something we haven't really spoken about in regards to the US that I think is more potentially a bigger deal than tariffs is the impact of Doge. You know, Elon Musk and his $1 trillion of cost savings in the government sector. You know, $1 trillion is a big number. I mean, that would mean the US government deficit halved, right? Now that is a lot of cutting of payments to companies. That's not about getting rid of, you know, the federal budget for paying people is roughly $290 billion for the civilian workforce. If you want to cut $1 trillion, you've got to cut payments to businesses. And that isn't really, no one believes that he can do that without, well, really crashing the economy.
Yeah.
But headlines don't help when it comes to business confidence.
Geoff, you're a political animal. We've got an election coming up here. Do we need a Doge in Australia?
We need a new government.
Oh.
That's a bit weak.
Well, no, it's unfortunately the last government just hasn't delivered. Yeah, they've changed the rules on franking, which they said they wouldn't, and because the industry funds can't work out what the realised gains is on a per person basis, they've said, oh, look, we'll make it tax on unrealised gains. So to me, hey, I'm not sure the alternates, their vision's any better. But like, this isn't being recorded, is it? Is this public? It is. Oh, okay, no problem. I won't say.
Keep going.
No. So someone who runs the finances is either really smart or really dumb, and either of them is not good.
Getting back to my question.
So back on your question.
Yeah.
So,
could it work here?
I mean, the tough thing is, from a capitalist perspective, that is, like when we're looking to invest in a company, you want, what do we look at? We look at a good manager, so a good CEO or a good leader, and an efficiently run company. Now, I think that's what everyone needs.
Yeah.
Now I know, the way Trump's doing it seems a bit extreme, and Musk, is really extreme. But you've got to run. If we want sustainable, unless we want the people that aren't in this room, our children and grandchildren, to suffer, we've got to step up.
Yep. No, fair enough. I want to check in on a couple of sectors. Jacob, I noticed I was checking out the Antipodes Global Fund today. There's a decent position in Barrick, one of the world's biggest gold miners, and gold has been the hottest asset class on the planet almost so far this year. What have you made of the sort of gold rush we're seeing at the moment?
Yeah, look, we've held it through for a while, but we certainly went harder at it when it sold off on some of its operational and cost management issues and some of its jurisdictional issues. It's hard to find the irony of investing in gold stocks is it's meant to be a safe, defensive exposure, but all their gold mines half of their gold mines are typically in fairly risky jurisdictions.
Yeah.
It's a false sense of security. Now, in defence of Barrick, they've operated, half of your exposure is North American, so hopefully that's safe. The other half is diversified across less, more risky locations, but they've got a long history of operating in those locations. And I think what you're seeing more broadly across the gold stocks is after a long period of cost inflation, they're managing costs down, running their businesses more efficiently. And now you're starting to see, after a long period of underperformance of gold stocks versus the gold price, you're starting to see it catch up as you get the operating leverage coming through. And we think Barrick's on about 7.5 times on spot and about a 50% discount to NAV. Now remember, in the 80s and 90s, Geoff would remember this, Gold stocks always traded at a premium to their net asset value. Why? Because there's a lot of gold in the ground at higher prices. It's optionality on higher prices.
Yeah, and normally, operating leverage is normally significant, isn't it? You're better off, like in theory, if the commodity's going up, you're better off owning the company that's making it because of the margin.
Yeah. And at the moment, gold demand has been driven by central banks. Retail investors have been too busy with Bitcoin, but they've finally started to come back to buying gold in ETFs. But that's only just started literally in the last 3 months. And gold has arguably been in a bull market now for 10 years.
Yeah, it's an incredible run at the moment. You wonder how far it can go. Jun Bei, I couldn't quite, you've got a new fund, 10 Cap. How's it all going?
It's going really well, fantastically well.
Excellent. Tell me how you're thinking about the banks in Australia. It's obviously been a fantastic trade for most of last calendar year. And then at about February 13, when NAB put out a trading update, and Bendigo Bank a couple of days before that, it's been quite a dramatic slide. Are you a holder of the banks, a shorter of the banks? How are you looking at that sector?
Oh, look, I think that sector is a little bit tough. Bank is like our tech sector. It's like our Magnificent Seven. It's our bank, it's the banking sector. Look, I think the sector itself is doing okay. Forget about the valuation part. The earnings not doing too badly. As I said, our economy is actually doing okay. The mortgage competition is not that severe. It's kind of okay. And they're holding their margin reasonably well. But clearly, by February, we start seeing that bit more competition coming through, margins coming off. How much of it is because we're heading into election season? Look, we don't know, right? But the things are as good as they can get, and they have held that for quite some time. Now, banks are Australian banks are probably one of the most expensive banking system at the moment in the world. CBA is the most expensive bank in the world.
And in history.
In history. And incredible business and everything else sets itself apart from the rest of them, but it just very expensive. Very hard to be a shareholder of CBA, especially for the next couple of years. When you can see there's other opportunities around, so that companies will grow earnings. CBA won't grow earnings. If anything, earnings will go lower. If the share market remains as it is, sort of tracking sideways or going a little bit better, banks will sort of stay as it is. Yeah. Unless there's some crisis coming through, US heading into recession, then you have real issues with the banking system. Then all the banking system around the world will be hit. But at this stage, they look benign, but it certainly doesn't look like it's going any higher. It's very hard to hold. If you want to buy a share, you don't want to put in the banks at this stage. You want to put into something else. I said, retailers, there's a lot of opportunities coming up. It's just not the banks. Great company, but it's too expensive.
Fair enough. We're going to get to some stock tips in a second, but I just want to check back in on AI, Jacob. There's a bit of tech in your portfolio. You mentioned we're sort of seeing, I guess we're waiting for the AI wave to move from the infrastructure creators and the hyperscalers through to those adopters. What company's going to use AI in a way that's really dramatically changing? Are you seeing any sign of this yet? Is that wave starting to reach the shore?
Oh, look, we all see it in our day-to-day use of Copilot. If anyone's had the pleasure of being, using its tools to, speed up the way we respond to emails.
I'm not good on emails. I don't read emails.
But I think probably what we're still looking for is that killer consumer app.
Yeah.
And that may be, in reality, may be a few years away. And I think where you will see adoption relatively quickly will be in companies like CBA, or in America, companies like Capital One Financial that are very tech-savvy financials or tech-savvy banks. They do exist. There's not many of them, but they exist. And if you back those, I think they will be the first ones who benefit from. If you think about what Capital One does, it basically is a credit card business. So what their two biggest cost lines are customer acquisition, marketing cost. That's perfect for AI. As we know with the social media companies, what have they done with AI? They've targeted consumers better with ads, and they're making a lot of money out of that. So customer acquisition, and then managing their credit cost line. And once again, large language models are perfect for working out who you should lend to. So if your data is centrally warehoused, and that's a big if, and that's a problem a lot of the American banks have, is they have very antiquated IT infrastructure, which will make it very hard for them to get those benefits. And so they're going to get outcompeted by companies like Capital One.
Yeah. Jun Bei, are you seeing any nascent signs of usage in Australia? Everyone's talking about it.
Yeah, look, absolutely. We all use it, right? But some to bigger extent, some to smaller. So everyone's talking about it. And the good news is that it's not just certain department talk about it, of course, corporate, right? From the top. So board is asking what they could do. Management is talking about what they could do. I think ultimately just help us to drive a more efficiency across the businesses. Save you time and do things better, and so that you can focus on the things that matter. So I think net, Australia is a little bit behind perhaps to some of the US counterpart, but it is talked about by every company we see, which is very good news. And then adoption will be coming soon. Consumer front is a little bit low, not yet. So we talk about all these computers with AI enabled. They're still too expensive, and then they're still yet to provide that much functionality. So JB Hi-Fi hasn't seen this wave of sort of purchase coming through, but it's coming. They say iPhone. I think it took to iPhone 2 or 3, this third generation before sort of adoption, sort of vertical pickup. So it is coming, but it just right now still that early stage. You just need that sort of app, something that's kind of for the consumer or cheap enough for consumer to adopt.
Yeah, I just use it to put my blood tests into ChatGPT.
Oh, and get interpretation.
Yeah.
Results.
Look, ChatGPT, I do use that quite a lot. It's quite cool. You put image in.
Yeah, you put the image in.
And then tell the image to
Exactly.
one day I said, look, go search
What
for my
do
image.
I need to take?
And it creates a digital image of myself.
Wow. I'm
Sorry.
going to save us from going into general hospital territory.
Well, no, it's all relative. You're young, but we're all older.
Jeff, let's do some stock tips. We've got 4 minutes left. I'm going to get
Yes.
a couple of stock tips from everyone on the panel.
Okay.
And you're going to kick us off.
Beautiful. Australian stocks.
Whatever you like.
One is a lower risk one.
Okay.
More an asset play, EVT Limited.
Right.
It's got about a little over $12 of property and trading at the high $13.
Yep.
And its operating business, if you take the property out, which they've said they're going to start selling, you're paying about 3 times for their operating business. So just a real value play. And then the other one is the other side. When I said to the mid and small cap guys, what's another one? And it's Catapult, code CAT. And I said, what PE is it on? And what's the catalyst? They said, it's not on a PE. But the catalyst is, they're talking about growing their revenue tenfold.
So this is a business that tracks, sporting teams use it to track their athletes, basically.
Yeah.
Get high performance data. It's
That's right.
Australian
And Josh Kennedy, who worked with us a little while, used to be captain of the Swans, now down in Melbourne.
Right.
He used to use it. But anyway, the guys, they're pretty confident that you'll get some. The catalyst will be sales beating the revenue numbers.
Okay. Jacob?
So in addition to stocks like Barrick and Siemens, in China we do think Tencent is just for what it is, we think it's a very resilient. It's almost like your personal infrastructure in China. They have WeChat, WePay, so it's combination social media payments, but arguably very under-monetized versus, say, what Instagram represents or Facebook. So on a PE of around 16 times, where we think they can grow earnings at around 15%. So it's a combination of an advertising play as well as a gaming play in China, but dominant, very dominant, and run by probably I would argue, one of the best management teams. Tencent management have effectively seeded most of the successful internet companies in China because those companies need their traffic to get started. Companies like JD.com in e-commerce, we all know PDD, who owns Tmall. So, an amazing company on a very, I think, low multiple relative to its quality. And China's the one place where quality as a factor exposure is very, very cheap versus, say, in the US where you're paying over the odds.
Yeah. You want to name another one?
if I have time, if I'm, you might want to give enough time to
That's
Jay.
fast.
Look, probably in the US, I mean, we do like the aging demographic plays in the US. We own aged care providers like Ventas, but we also own HCA, which is a hospital company that over-indexes to the warmer Republican states, so Florida, Texas, where you have wealthier, older demographic. A lot of wealthy retirees end up in Florida. So, and they dominate their urban markets. They typically have about 40% share of the hospital and clinic networks in those markets, so they can dictate pricing back to the insurance companies, which is very important. And they've been growing their business at around 10% per annum for for decades. And that because of concerns around regulation under Trump, it's derated to around 13 times. And we think they're large enough and low cost enough to withstand any regulatory change.
Jun Bei, bring us home.
Absolutely. So first one, easy. JB Hi-Fi, share prices come off because the US volatility. Company doing incredibly well. Rate cut and new category. So, your PC and, AI enabled, always beneficiary of it. And to be honest, all of us, when we have a bit of time, I love walking through it. And my kids, in terms of gaming, just, we just can always spend more money in JB Hi-Fi. Market leader, very well managed, just incredible, impeccable execution really by management. I think it's a great business to have in the bottom drawer. Another company is interesting. It's in the healthcare space. Recently been sold off because of the potential tariff impact. That's Fisher & Paykel. Now, this company is always, being a little bit more expensive because it's very defensive. It sells, during the COVID period, it sort of made a lot of money putting product in through the ventilators and then oversold, and last couple of years been a bit tough. But now they threw that. So actually the business is doing really, really well. All of a sudden, this year, it's down, share price down 15% because they make a lot of their stuff out of Mexico. So, and then so company actually got onto the front foot, told everyone, said, look, it's going to be 15% hit if we don't increase our prices. But clearly they will. These are live critical equipment. But they say, if we don't increase prices, 15% hit. So analysts already put into their numbers. Now, there's chance whether the medical equipment should be part of it and the potential will be taken out because last time did. But regardless, this is your opportunity to buy a company that had just really structural tailwind to drive this business. And the core business itself is actually upgrade. Earnings result is coming very, very soon. I do think this share price, you move higher very quickly.
Well, it's a great rundown of companies. And I think if you think about all the 6 stocks we've had there, it's a mixture of companies that can navigate around the Trump excitement, and a few that are opportunities almost because of the Trump excitement. So not a time to panic. I think that's the message we've got out from our panel here. Don't panic. There's a lot of excitement to come probably on markets and a fair bit of volatility, but there are opportunities out there. Ladies and gentlemen, will you please thank our fantastic panel, Jun Bei, Jacob and Geoff.
Thank you.